and welcome to this webinar of Scientific Infra Private Assets. We are here to talk about climate impact, transition, and physical risk solutions. It's widely known that climate risks are important for investments landscape today, and it's recognized as one of the most critical risks that investors face. But the challenges that investors are facing in reporting against these risks or assessing them, or in fact going as far as managing these risks in their investment process, it's quite real. So to that end, in this webinar, we wanted to present some of the data and solutions that we have put together. We have been working quite hard on developing these solutions. And today we wanted to show you what solutions are available and are on offer through our platform. And as well as we wanted to highlight, how these solutions are aligned with reporting requirements such as TCFD. And finally, we'll take a very practical use case of how investors can implement that data and solutions for their own infrastructure portfolios. So today, I'm joined with my colleague, Nishtha Manocha, who is a senior ESG research engineer, and we'll take turns and present this webinar to you. So just a quick word on the Institute, and I'm assuming that some of you are already familiar with us, but still, we've been doing research on infrastructure for over a decade now. We started off first with the Institute housed within EDHEC Risk Institute, and we did quite a few research programs on asset pricing and risk modeling of infrastructure. In 2016, there was a separate institute created just focusing on infrastructure and private assets. And about 3 years ago, we have created this commercial venture called Scientific Infra Private Assets, which is responsible for providing this data and services that we are offering you today and showing you today. Here's the agenda for how we are going to structure this presentation. First, we are going to talk about what data and solutions are on offer. We are going to go in a bit of detail, tell you a bit about the value add that we bring in. Then we'll address why these solutions and data are really needed. What are the challenges that investors are facing? And we'll take help from some of the surveys and polls that we have conducted in recent past to bring that point home. And then I'll hand it over to my colleague Nishtha, who is going to show you this case study of how the estimate of climate impact and transition risk, as well as physical risk, can be obtained for an infrastructure portfolio. We'll also give you an illustration of how we can estimate these risks and impact for any portfolio, given some data contribution from our clients' portfolios. And finally, we'll leave you with some key takeaways. So just starting off, first I want you to talk a little bit about Inframetrics. This is the platform where we house all this data that we are going to show you today. It has 4 different components mainly. First is the indices and benchmarks, which is widely popular, and these are the benchmarks which are representative of the infrastructure market in general. These are fair valued benchmarks capturing the risks of underlying investments, the interest rate environment in the market, as well as the individual cash flow forecast of each asset. So they're built bottom up, very comprehensive and representative of the market environment. We also have a lot of valuation tools on offer. These are representative, granular, that you can select a particular sector, geography that you are interested in, and adjust those valuation inputs in your own process. So you can get information such as valuation ratios, multiples, discount rates, so whichever method you are interested in, either an income valuation method or a market valuation method. There are tools on offer that allow you to value your own investments and portfolios. Then we have this index constituent level data. So all the data, the financials, valuations of individual assets that go behind the benchmarks or these valuation tools are available in this product. And finally, what we are here to talk about, the climate impact and risk metrics. Here we have a lot of data on the individual assets. So their carbon emissions, that is the impact, their transition risk, their physical risk, how these assets are going to behave in different climate change scenarios. All the data is available within this product. So just to touch upon this in a bit more detail, there are 3 main use cases that we serve with this data. First is obviously the impact assessment. What kind of impact these investments can have on the climate? That's in terms of carbon emissions that they emit today. Then these products can also be used for risk management. You can try to understand, where the climate risk might be high, what sector of what part of your portfolio, and how to manage them going forward. And finally, for reporting requirements that are becoming widely popular and mandatory in many geographies. This data is available on the baseline, that is the estimates as of today, and the scenarios. So we not only look at the dollar value of some of these risks that you face today, but also in a forward-looking assessment manner that what if we get to a delayed transition scenario, then what happens to the financial risk that you face in your portfolio, and so on. We have a lot of granularity at this data. We offer all this information at the index level. So if you're already using one of our index benchmarks as a benchmark of your portfolio, then it becomes quite straightforward that you can use it for comparison, but also to understand where the market is at, benchmark, and it just based on those granular and robust proxies of climate data, what we call climate comps. And that gives you a good estimate of transition risk. We'll touch upon this in a lot more detail later in this presentation. And finally, there's a dedicated service to capture the exposure of your portfolio. So using some of your portfolio information, what assets are there, where they're located, etc., we can produce a very detailed report on the transition risk and physical risk that your portfolio may face today, as well as in different scenarios. And we'll show you an illustration of this service as well. In terms of the coverage, first we look at the transition risk. Here we have got baseline asset level carbon footprint, intensity, impact on the NAV in different scenarios for hundreds of infrastructure companies. And we look at scope 1, 2, and 3 emissions. So it's a very holistic solution to offer for transition risk. On the physical risk side, we have looked at hazard events such as storms, floods, and heat. We have this data for hundreds of infrastructure companies again, and we are expanding this coverage to a lot more, thousands of assets worldwide. So we keep evolving this product as we collect more and more data. These metrics are highly granular, and they represent the sort of extreme weather damages that can happen if any of these events occur today, as well as in the future with some probability of occurrence. In terms of the summary, we have essentially these two types of solutions. One are the data products, which let you think of it in a self-serve manner, how you would go about estimating climate risk for your portfolio. And the second is the custom service that we can offer for your portfolio, given some data contribution from your end. So if we talk about the data, we have got this climate impact and risk metrics at the index, market segment, and asset level. So everything in Infra Metrics can be thought of, either at the asset level. That's the most granular segmentation that we have available. But also you can try to understand what sort of climate risks are there in transport sector, in utilities, and so on. So that goes beyond that. And finally, if you are already subscribed to our indices, then you can assess, you can benchmark the climate risk in this portfolio versus an index that we have on offer. We measure these baseline climate impact and risk metrics, the exposures to transition physical risk. And starting from this baseline, then we can also forecast, based on certain climate change scenarios, what can happen to these transition physical risk for those same assets, segments, or indices that we talked about. It also allows investors to build these custom proxies. I touched upon this initially. Essentially, we are telling you that while we may not have all the assets out there in our system, but we let you build these proxies based on assets that are similar to the investment that's under consideration, given some characteristics of the asset like size, revenues, and so on. And also looking at some profile of the asset, for example, which geography it is in, which sector it is in, and build these custom proxies. That's all the data solution that we have on offer. And then finally, on the services side, we provide these services through a dedicated application of this portfolio. The custom analytics can get very specific to the assets that you hold. If you have directly held assets that you are directly invested in, then we can assess the climate change on asset values, so the financial dollar value of these assets until 2050. So we can give you an estimate of how much impact these climate change scenarios can have on the NAV. And if there is less information, maybe you are invested indirectly via funds, we can use a proxy approach that I just described, but also expand this not just on transition risk, but to physical risk characteristics as well, and give you an estimate of a complete climate risk profile of your portfolio. And if we just want to talk about a unique value add, why we do this. Well, our infrastructure sector that we cover is quite broad, and that's one of the reasons why we have these benchmarks segment data available for infrastructure. It covers 500 plus assets across multiple markets. This level of representativity allows clients to generate this risk metrics for a specific infrastructure portfolio. So it includes accurate and reliable climate impact and risk proxies. At the portfolio level, that is, you can estimate finance emissions or carbon intensity as a ratio of per dollar of revenue, or the price of the assets, or the extreme climate value, the transition risk, for example. And you can do this for different climate scenarios, different time horizons. So it's a very rich data set. These are accurate and reliable benchmarks of the carbon intensity and transition risk. So it lets you understand where your portfolio is lacking in some areas, where there's scope for improvement, and accordingly also influence your investment process. An assessment of valuation of physical risk metrics for multiple hazards. We look at 3 hazard events right now, but we can also look at some more in the future. But the point is that these offer, the physical risk metrics, which are baseline, that is the impact of these hazard events given some probability of occurrence of these events, but also in the future, in the climate scenarios, in horizons by 2030, 40, 50, what can be the impact of physical risk on your portfolio. Now, all these metrics are PCAF aligned. We have looked at, the modeling details and came to a conclusion that they are very well aligned with the PCAF scores between 2 to 3, and can be used for TCFD reporting as well. We have a dedicated team of data scientists and infrastructure experts who provide an independent view on this. So we don't have any say, but we rather are an independent party offering these solutions and of the best approach possible. Now, if we just talk about quickly on the need for these solutions, having understood what data is out there, what are the services that we offer, it's important to understand why they are useful, and some of these will jump to you directly. We conducted this survey last year where we asked 130 plus asset owners and managers which ESG impacts and risks are material to you. So in this table, we are showing you their responses. So we asked them to rank between these 5 categories: impact of assets or companies that they're invested in on climate change. That's the first column. The second is impact of assets, companies on natural resources, then on human well-being, on economic development, and then finally the governance impact on organizations. And it's not a surprise that impact on climate change is ranked first, almost 65% of the time. So this highlights that the respondents are very concerned about the transition risk, and that's why we do what we do on the transition risk products. Similarly, we also asked them to assess or rank these risks on the ESG category: physical risk, access to natural resources risk, social acceptability, workforce availability, staff quality, or organization. And the respondents ranked physical risk the highest, almost 60% of the time. So together, this puts the picture in very clear contrast that transition risk and physical risk are the most important in terms of the ESG impacts and risks today. This is another way to look at this. So this is the result from the same survey, but we asked the question that why they need the ESG data. What are the driving factors behind? So obviously the most important one is to identify and manage risk to investments in all geographies. That was the most important reason. And the second most important was the reporting to stakeholder society or to the regulators. That came out to be the second most important reason. And this is where we talk about the alignment with TCFD, or the IFRS organization. There are essentially these two reasons why the ESG data is important, either to assess and manage the risk or for regulatory purposes. And if you talk about this TCFD reporting in a bit more detail, here we are showing you the different pillars of TCFD disclosures and where our products and solutions add value. First of all, as part of this TCFD reporting, you're required at the company level or asset level reporting is required within the organizational boundary, or portfolio reporting of climate risk and opportunities as aggregated, or you are also encouraged to benchmark the performance of portfolios. So there are these two pillars under strategy and metrics and targets, where we offer the data on climate risks, transition risk and physical risk data. And we offer the carbon emissions, climate impact data that serves the pillar in the metrics and targets, where you have to disclose your scope 1 and 2, and if appropriate, scope 3 greenhouse gas emissions. Now, having understood these, that it's important, investors want to do it, and it's required for regulatory purposes, but still there are a lot of challenges that are faced by the investors. First is that the need to measure and report, including indirect investments. And that's the difficult bit, because if you're directly invested in it, you probably have good understanding of the asset, its characteristics, and so on. But if you're indirectly invested via funds, you are limited in information. Second, the carbon emission data is quite often missing, partially available, and seldom scope 3 is covered. So it's a real challenge, right? That if you don't have all this information available, then how can you report it for the portfolio, which requires that aggregation? And you'd also lack this picture of where you are headed in terms of risk for the portfolio under different scenarios. That's impossible to obtain. And the third reason is that there are different reporting initiatives now. There are so many being enforced by governments. For example, TCFD reporting is now mandatory in 8 countries. And it requires reporting scope 1, 2, and 3 gas emissions, weighted average carbon intensity, total emissions, climate scenario-based analysis, physical risk in different climate scenarios, and it promotes the use of benchmarks to understand the performance. So all these things have to be reported in the countries where TCFD reporting is now mandatory. But it's not just that, right? Because your portfolio is a global portfolio, typically in infrastructure. So you have to adhere to these requirements in different geographies from different governments. And that makes the aggregation a lot more difficult. And beyond reporting, the pressure to manage and measure these climate risks is real, right? And that's one of the reasons in a last year's survey that investors highlight, that they want to assess and manage these investment risks. And you can't do that directly without proper reporting or knowing where you are today. So on that note, we recently conducted this webinar just a couple of months ago on physical risk. And we asked, in practice, how do investors look at it? So what impact do you believe physical climate risk will have on your infrastructure investments? More than 80% of the investors, they said that it's going to have a medium to high impact. And that's quite serious, right?
So obviously, they realize that the impact of physical risk can be quite drastic on the infrastructure portfolio and investments. And second, we asked them, have you implemented an evaluation of physical risk yourself? And again, majority of them said no, 69%. So while it's important to understand and measure, the current state is not really that great. That in practice, there's very few investors who have implemented it in their investment process. So at this point, I wanted to ask this question to you now. Looking forward by 2030, which of the following risks, according to you, will be important from a financial point of view for your organization? Are you more concerned about transition risk, example, carbon tax, reputation, market risk, and so on? Or the physical risk, that is the physical damage of your investments, or both are equally important for you? The poll is live, and please feel free to submit your responses now. Okay, we are getting some good results here. Maybe let's give it a few more seconds, 10 more seconds then. Right, okay. So I'm ending the poll now, and I'll share the results. So majority of the people said that both are equally important, but between transition and physical risk, there were more responses towards transition risk. So this is quite interesting. And this is also, in terms of the climate risk, we expected that both would be important, but also the transition risk, plays a role as well. So that's quite interesting for me to see. And we have solutions, obviously, that can cater to both transition risk and physical risk in our data. So at this point, I'm going to hand it over to my colleague Nishtha, who is going to take you through some case studies of how we implement these data and solutions on an infrastructure portfolio, starting from climate impact transition risk to physical risk. Nishtha, over to you.
Thank you, Abhishek. Thank you, everyone, for being here with us today. I hope my screen is okay. So the first thing I wanted to talk to you today about is transition risks. As Abhishek just highlighted, that transition risk and physical risk are important. People are paying attention to it. And as the survey results showed, that almost 65% of investors believe that transition risk is the most material risk that they will face. So we did this study a few months ago, which is on my screen now on the right, which we call Highway to Hell, where we tried to estimate the cost that the infrastructure sector as a whole will bear if transition risk was to manifest in full force. And that number that we found for all the assets that we track is $600 billion. So this means that in an extreme scenario, the infrastructure asset class could be looking at losing about $600 billion of money in this situation. Now, given that it's important and having established its relevance, we wanted to show you how we can help measure or estimate this risk. So as Abhishek mentioned before, we do estimates for transition and physical risk at the asset level, portfolio level, and we also do this at the index level to provide benchmarks. So I'm going to run you through all these different levels of assessment with case studies. So the first thing that we do for transition risk or carbon impact assessments is asset level emissions. And here, when we start to do our carbon emissions, we build these models. So I had a question about this in the QA session as well. So our emissions scope 1, 2, and 3 are modeled by very detailed models that we build in-house. And we, based on the data available for any given asset class or any given asset, we take two approaches. So either we follow a statistical approach where we run regression models to estimate an asset's carbon emission, or we undertake a physical approach where we take the physical quantity, like an asset level usage, electricity used, fuel burnt, etc., multiply that with a relevant emission factor and predict the emissions. In doing so, for our tracked universe, we have scope 1, 2, and 3 emissions for about 500 plus companies. So what this does is this helps us build an asset level emission database that we can then use for further analysis. So for example, this asset level database can be used to estimate the emissions of your entire portfolio. Now, while doing a portfolio level analysis requires you to know the emissions of every single investment in the portfolio, which becomes difficult. And as Abhishek pointed out, it's a cumbersome process. Data isn't available for everything. So we've come up with a process to do this using climate comps, or we call this climate proxies. So let's look at this example to understand it better. Assume you have a portfolio of infrastructure assets across multiple sectors and countries, where you as an investor need to report its emissions for individual assets for the whole portfolio, as well as the whole aggregated portfolio as well. But to do this, now you need consistent emission data. So the solution that we provide takes each investment in the portfolio and maps it against an inframetric database to find a more suitable proxy. Of course, there have been conversations where we know that estimate-based proxies are an average value. But given that we average this on the basis of asset characteristics, when we have a large enough portfolio, this builds consistent estimates. This is the methodology applied. So just like we use in our financial comps analysis, the comps methodology looks at an infra project as a collection of its common factors or characteristics. And these could be as many as you want. So for example, a road, you could think about a road in terms of, you could compare it to different roads by looking at the size, by looking at revenues, or by looking at its business model. And when you do this, you are taking a logically selected set of comparables, which brings you down to a better estimation. So let's look at an example. So in that portfolio that was on my screen before, the first line item was Sydney M1 Eastern Roads. So say you want to estimate the emission of Sydney M1 Eastern Roads. You assume you don't have reported information. How do you go about it? Using the comps method, what you would do is you would look at what bucket it fits best in. So here we use 3 buckets of sector, size, and revenue. So given that it's a road, the global bucket for sector would be roads, which has an average emission as shown on my screen. Second, you look at its bucket. So is it a small road? Size bucket. So is it a small road, a medium road, a large road? Once you know that, you map it to its average emissions for that particular bucket size. And finally, you look at revenue. And once you start putting this company in the context of these 3 buckets, you soon realize that from our Infometrics data set, we have about 394 data points that can be used to build this proxy. So using that, averaging it out, we come to the conclusion that this road has an implied emission of 3,071 tons of carbon. Now, how good or bad is it? Let's see. So we can, I showed you how this goes through the first example, the Sydney M1 Eastern, and we can do this for every single asset in a portfolio. So every single investment in the portfolio is mapped against Infometrics to find the most suitable comps with enough data points. While we understand that estimates based on proxies can be a little imprecise, but it is an efficient and consistent method to estimate and report carbon emissions at an asset level for the portfolio, and I'll show you why. So the reason we chose this portfolio for our proof of concept or comparison, why we're presenting it to you today, is that for all the investments, all the 43 investments in this portfolio, we have reported data. So we estimate the emissions that we calculate using comps, and we compare it to the reported data. And what we find is that the difference here is only minus 9.3%. And doing this across examples, we find that our estimated carbon emissions are always within 10% of reported carbon emission estimates. So that's what I meant by it being a strong enough estimate. And this is something that you can do yourself. So when you log on to our Infometrics platform, the carbon proxy comps, so this comp calculator is there, where you have the option to create your own climate impact and risk proxies with a tool by which you can select your size of buckets, you can select how many you want them, and undertake a comparison based on your customization. What we also have in our portfolio are index level benchmarks. So for TCFD reporting, it is recommended that you provide a benchmark. So you compare your performance against a market benchmark. So for example, you want to know whether your portfolio is more or less impactful in terms of emissions. That means, is it more or less exposed to transition risk or not? So what we do is we take Infra 300 as a benchmark here as an example. And for the same portfolio for which we calculated emissions some time ago, we see that when we compare the emissions of this portfolio against a benchmark, this portfolio performs much better. So this means to say that this portfolio is less exposed to the market as represented by the Infra 300 index. While we have index level benchmarks, we also have sector level benchmarks. So if you're familiar with TICS, which is the Infrastructure Company Classification Standard, it contains a set of infrastructure sectors. So for each of these sectors in Infometrics, we have the average emissions. So given that same portfolio that we had, when we look at it by sector, we see that some sectors outperform the Infometrics database and some of them don't. So you can come to these analysis and conclusions when using the Inframetrics sector database. I wanted to reiterate Abhishek's point from a few minutes ago, is that while the example here showed you an estimation of baseline and today's carbon emissions, we also have the capacity to build this through scenarios. So through our models that we have built over the past few months, for each scenario, starting at the asset level baseline, we can estimate the evolution of carbon emission assets in each year until 2050. And this has been, this is aligned with IPCC, and the scenarios that we use are aligned with Oxford Economics and NGFS. I want to take you through another case study where we now show you how to estimate physical risks. Starting again with the big picture. So we did an analysis of the entire Inframetrics universe, and we published it in a paper called It's Getting Physical. Now, this paper showed that in the same portfolio, under an extreme climate scenario, you can lose 54% of your value. And this makes sense. It is aligned when investors in our survey said the most material risk is physical risk, almost 60% of the time. So this again goes to say that physical risk is quite important. So what is our approach to measuring physical risk? Now, when measuring physical risk, we take an extremely granular approach. So we take your asset, we draw a geographic polygon on it, we superimpose this with our in-house hazard models, and then we find at what location, at what precision. So for example, our flood models have a precision of 30 meters by 30 meters. We can then identify the location and physical footprint at this level of granularity. Now, once we know your asset at an extremely granular high definition model, what are the hazards it is exposed to, we then bring in our insights from damage functions. Now, damage functions are based on civil engineering principles and engineering design that tell you for a certain level of hazard, what would its corresponding damage be. So we have damage functions for different types of infrastructure assets for different weather events. In total, we use about 34 different types of damage functions mapped to individual TICs classes to bring these insights on physical risks. And with all of this, what we can do is we can compute the percentage of assets that is impacted and the financial value that is impacted today. This is an example that I'd like to present to you today. So on the left, you have the Birmingham Airport in the UK. So the first step is we map it out. The second step is we identify the damage function for airports. So as you see, damage function tells you for any given flood level, what is the potential damage this asset faces. And finally, we model its climate hazard. So in a 1 in 100 year event, we run this through our weather models, our hazard models, and we find at exactly what location, how much of the asset has what level of flood, which can then give you, which can then be translated into a financial value of risk. So for this particular example, the physical damage from a 100-year return event is about 7.8%. That means about 7.8% of the asset is damaged. So your value at risk is about $68.7 million, and your expected loss is about 0.68 million. And again, we can do this not only for physical risks today, which is baseline data, but we can also do this for different climate scenarios as outlined by NGFS and Oxford Economics. So going a while, this example that I showed you was an asset level example. I would like to point out that this can also be done at a portfolio. So when you have a portfolio, we can produce physical damage estimates using asset level information and specific damage functions, as I just showed you before. These estimates are available across scenarios, and these can also be compared against a benchmark. So for example, you have the same portfolio that I showed you before in different climate scenarios has these percentages of damages. So 2.22% under an orderly transition, similar under disorderly transition, and 2.85 under no transition. And the benchmark here is about 1%, 1%, and 1.3%. This means that our asset is more exposed to our portfolio is more exposed to physical risk than Infra 300. Another service that we can offer when it comes to physical risk is, it's possible to look at any existing asset and define its physical risk. We can also do this for assets that don't exist or assets that are now under construction or you're thinking about building them. So how do we do this? For new assets that you're trying to understand your risk estimates for, we can produce the same information of physical damage at risk, physical value at risk, expected annual loss for 150, 30-year return periods, for floods, storms, cyclones, under different climate scenarios. Now, what we need here is the location, the potential investment sector, and the total investment value. Now, here is where our insights come into play. So say you're building a power plant in a certain location. What we can do is we can say that a power plant in a certain location is typically of the size and covers this type of physical footprint. With that information, a sector-specific, geography-specific understanding of what an asset is like in different parts of the world, we can then build a geographic polygon, which then goes into our risk assessment models, which then follows the same process of hazard analytics, which gives you the physical risk. And that our transition risk and physical risk metrics that we showed you can be lumped together into an evaluation service. So first, for example, at the asset level, for any given asset that you have, we are now in a capacity to pick it up and tell you what its climate emissions are. So what are your carbon emissions? What are your financed emissions? What the transition risks are, what the physical risks are, and what your NAV is. And as I mentioned, we can do this across climate scenarios, across time horizons. And a similar exercise can also be conducted at the portfolio level. So we can take your portfolio across the world, and we can tell you your climate impact, transition risk, physical risk, and NAV. Now, before I go to summarize and give you the key takeaways of today's session, I'd like to have a second poll. Natalia, if you could help me launch this poll, thank you. Let's give it a few more seconds. Responses are coming in. Five more seconds. Okay, let's end the poll. And thank you for all of you who answered the question. I'm going to share the results here. Now, as expected, while of course you need high-level understanding of what physical risks are, which is a sort of a relative assessment or rating or a score of your physical and transition risk, it is very important to understand your precise climate estimate metrics. And this is because you cannot do risk management with a high-level analysis, and you cannot report against regulatory requirement with just high-level analysis. Thank you, everyone, for answering that poll. I am now going to give you the final takeaways of the session, after which we can answer a few questions. So the first thing that our research shows is that climate risks can be very high for a growing proportion of assets. For example, more than 80% of investors surveyed by EDHEC Infra agreed that climate change can have a medium to high impact on infrastructure investments. Second, these risks can be managed, but first they need to be measured. But investors find it challenging to measure because climate impact risks, they find it challenging. Sorry, just give me, I'm going to redo this. But investors find it challenging to measure climate impact and risks consistently for all assets in a portfolio. More so for asset owners where the majority of which are indirectly invested through private assets via funds. It's because here they don't have access to the data directly. Inframetrics provide solutions here to estimate and report carbon emissions, transition, and physical risks for individual assets as well as portfolios. When using inframetrics, investors can also benchmark these risks against the market and find investment opportunities aligned with their climate goals. Finally, combined with an asset pricing framework, this makes the estimation of the dollar value of risks possible in various climate change scenarios. Thank you all. We will now take a few questions.
Yeah, I think, Nisha, there's a question about, I saw that besides 1 in 100-year flood events, which are the hazard return periods used and why were these selected?
Right.
So I know which ones do we have, but why were they selected? Do you have an idea of that?
So in the hazard events, we have 1 in 100, 1 in 50, and 1 in 30 years. I think here one of the primary questions of selecting these return periods is of course, data availability. So because generally it is expected, the international community sort of, condenses itself against these 3 return periods. So that was the main reason. We wanted to be salient with what everyone is asking for and what everyone understands.
There's also a question about, can we apply bespoke scenarios instead of NGFS on Oxford? Yes, I think so. I mean, at the moment, it has to be through a custom service, but certainly the functionality is there because we understand that none of these scenarios are perfect, right? We have also observed, some drawbacks in these scenarios, and that's why we have not just include one, but we have a comparison with another provider like Oxford Economics. But if you have a scenario that you are keen on, then obviously we can integrate it in the solution.
There is another question here about, do we have data for renewable energy assets? The answer is yes, we cover the renewable energy sector quite significantly. We have another question on how many data points do we have on scope 3 emissions? While I don't have the number offhand, but I know at minimum it is 500 plus companies that we have scope 3 emissions for. Look at a few more questions. There is another question here about the assessment of physical damage. Is it just so the question is that, is this just the cost or loss of physical damage or the loss of operations as well? For now, the damage functions only account for cost of physical damage. So operational damage is something that we will build in, but it's not there now.
There's a question about, can you run coverage checks for portfolios? So this, I think we've been battling with as well, because, while we have an extensive data coverage, it can never be perfect. So we have got some gaps in our own index benchmarks coverage as well. So we can do that coverage check quite in a robust manner, but also the ones where we have gaps or the assets that we don't cover, we can use the proxies and comps to get to an estimate for transition risk and use some approximation for physical risk measures as well. It's possible, but yeah, to a limited capacity right now. Do you know how accurate your estimates are? Well, we try to show you a sort of illustration on transition risk, where we have basically used that comps method for the whole portfolio estimation, but also looked at the actual reported information for those for that same assets, and we try to compare them. I don't remember. Do you remember, Nishta, what was the error? I think it was about 8 to 10% roughly, right?
Yeah, at most 10%.
Yeah.
I'll take another question about damage functions that we have here, where there's a question about the reliability of damage functions. And you're absolutely right when saying that this data is sparse in some parts of the world, and in a lot of areas that it doesn't exist or it's unreliable. So when we use these damage functions, we undertook a very robust literature review. So we looked at damage functions for infrastructure assets by category in different types of the world. So most of our damage functions come from government sources, come from, so for example, the European Commission builds some damage functions, FEMA builds some damage functions for the US. We have similar ones in Australia and New Zealand. So after very extensive literature review, we try to be as granular as possible. And we've built a big set of damage functions where we use the ones which is the most closest to the asset in any given geography.
I think the same thing is true about the sectors as well, right? We have the damage function that are specific to the activity. So that's also another reason why our estimates are, quite robust, because we haven't used some generic thing that applies on the whole portfolio.
Mm-hmm.
There's a question about physical hazard stressors include heat wave or drought. I think.
Go on.
Go ahead.
So our physical
data.
Okay,
one at a time.
Physical hazard data includes heat risk, so includes risk from high temperatures. So while this will account for heat wave, droughts in terms of if you have the maximum temperature of any given location or asset, then yes, we can do it. There's a similar question on including what do we mean by temperature? Now, what do we mean by what type of physical risk is included in temperature? Do you mean overheating or extreme cold? Does it cover wildfire and drought risk? At the moment, we can do extreme heat, and we are building in capacity to do extreme cold. We do have data for wildfire and drought as well, but that is not at the moment on our platform.
How do you factor in lessons learned about risk from older projects used in your calibration that may not be replicated in new projects? Now, there's an interesting one. I think to some extent, we've looked at, some real examples of physical damage. Like most recently, we looked at that Italian asset to compare, what sort of damage that asset faced and where our estimations would suggest it. So that in a way is a robustness test. But obviously the technology and the infrastructure universe itself has changed quite a lot from the older projects. And that's why it's not directly comparable, but we do look at, the past events wherever we can find the data and make sure, from a robustness point of view that we are sort of assess where our estimates are. I think there was a bridge, right? A toll road, if I'm not wrong. In Italy, the one that we looked at.
There is also another insight that we can have here. So sometimes when we do this sector level studies, there are of course outliers. So for example, we looked at a few airports. This was a roads example. We were looking at a few roads and when we were estimating their scope 1 to 3 emissions. And we very quickly realized that roads in a certain geography were showing, so the reported emissions of those roads were way lower than what our models were predicting. And in this case, when we looked at it, we saw that the emissions fell considerably year on year. And this was because they had just switched to a renewable energy input. So in those cases where we can see these outliers and we see this changes consistently, we build it into our models. So for example, for now, for these particulars kind of assets or type of assets, we are more aware that these are switching to renewable energy. And so their scope emissions will fall accordingly. And these sort of analytics and insights from the research team, which is about 10 people strong that do ESG data, are being incorporated into our models every day. There's one final question. How does your physical risk model take into account network assets scattered across different locations within a country? Example, tower networks, fiber optics, water pipelines. That's a very good question. Thank you for this. So when we look at an asset or the company that owns the asset, if it's a tower network, for example, we'll map out the towers exactly where they are. They may be across 300 or 400 kilometers, that doesn't matter. So we map out the actual towers and run the hazard model at that location only of the towers. Similar goes for pipelines. Of course, they are buried and fiber optic cables are buried. So it's just a thin line that goes across our geographic system, which then predicts the hazard for that particular asset or company.
Okay, I think those were all the questions. If there are any other questions, then please feel free to write to us. And we'll be in touch about sharing the slides and the replays after the webinar. And finally, thank you from my side as well for attending this webinar. I hope you enjoyed it. And I hope you find these data and solutions that we presented to you today useful.